Well, welcome. It is great to see everybody here. You know, let's try that again. Good morning.
Good morning.
Okay, there we go. Okay, I want to get us started the right way. Well, it's great to see you all here. You know, this is our 33rd annual Client Economic Outlook. So it is our pleasure to host this. This is all about thanking you for your trust, loyalty, and confidence over the years. Also about giving you some insightful information in an economy and a market that can be somewhat confusing. And it's also enjoying a nice lunch with a great dessert. On behalf of your financial team, specifically your leadership team of Tim Kimmel, Adam Jordan, and myself, it is truly, again, our pleasure to be part of your lives. So before I bring up Tim, think about what the economy has provided or delivered the last 6 to 9 months. Think about what you've been hearing in the news. The positives, we hear strong corporate earnings. We hear a resilient stock market. We have relatively strong consumer demand. But on the negative side, there's persistent inflation. There's geopolitical risks and certainly high valuations. Well, think about all that. This is going to be a survey. So, and you think about that as you listen to the news, as you hear what I said, I'm going to ask you a question. And this comes down to about the glass. Is the glass half full or half empty? That's where I'm going with this. So, how many in this room, and of course when the glass is half full, it means you're optimistic, half empty, it means you're not. So how many in this room feel the glass is half full and kind of optimistic about what's going on? Okay, thank you, about 30, 40%. How many think the glass is half empty? How many just want a new glass? Okay, well, our speaker's going to unpack all that. I've set the stage up for him, so he'll unpack it. But, you know, I want to introduce my great friend, principal and partner at the firm, Tim Kimmel. We've been together for 30 years. I don't know, it's almost that long, it seems like, Tim. Again, you all know him as a senior advisor. You all know him as a great friend and a dear associate, along with and counsels many of you as well. And we are our chief financial advisor. So, Tim.
Well, thank you, everybody. Yeah, it's actually probably been 32 years, but who's counting, right? So, yeah, and a couple of things, too, I'll mention is that Paul mentioned the glass half full, half empty, but one of the things that when Paul introduced the 11,000, it's like, well, where was the Dow when I started? Where was the Dow when Paul started in the industry? And kind of dates ourselves a little bit, but when Paul started, the Dow was at about 1,000. And it was about 2,500 when I started. And today, the Dow's at 47,000. So whether you think the glass is half full, half empty, just keep in mind, it's time in the market, not timing the market. That's important. And good companies, they do go up and down too, but they don't stay down. They generally do well and become more valuable over time. So with that, a few administrative things too I want to address before I introduce Jason, our speaker. There are, if you noticed on your tables, note cards and pens. And so this is a participation sport, right? So we want you to participate. Jason has some great things to share, but he wants to hear from you and the questions that you have. So if during the presentation, if you have questions, just jot those questions down on the note cards and then lift them up, or at the end, Adam and I will come around and pick those up. And then we'll be asking the questions on the note cards that you have. So we very much want your participation, and we want to address your questions today. So take advantage of that, please. So with that, I'll just read this for Jason. Jason Vaillancourt, he's a chief portfolio strategist with Columbia Threadneedle. A lot of you have Columbia funds in your portfolio. Columbia Threadneedle manages over $650 billion and exclusively works with financial institutions like ours and other institutional clients that they have. Jason is responsible for developing the firm's capital market outlook and communicating global macro views to the firm's clients and stakeholders. In other words, Jason has the ear of the portfolio managers, and he is the one that actually goes out and is kind of the liaison between the portfolio managers that are actually managing some of your money and kind of disseminating that information to their clients, you. Jason joined Columbia Threadneedle, but before that, he's been in the industry for a long time. He worked for a company called Putnam for over 25 years, and it was the co-lead in the firm's multi-asset management team. So he was the portfolio manager at one point. Now he's the liaison working with managers and, again, disseminating the information from them directly to you. Jason also received his BS in finance from Northwestern University and MBA from the University of Chicago Booth School of Business. In addition, Jason holds the Charter Financial Analyst designation. So Jason comes all the way from Boston, Massachusetts area. So he had to navigate the TSA and the air traffic control issues to be with us. So with that, let's welcome Jason.
Thanks, Tim. Thanks very much. Good morning-ish? Like, in 2 minutes it'll be good afternoon, but right now it's good morning. And Northeastern, not Northwestern. Northwestern is the bad Huskies. I'm an East Coast guy, although Northwestern was very close to where I went to business school. I think that's forward, yeah. So thanks for your time. I want to thank Paul and Tim and Adam for inviting us here this morning to get a chance to talk to you and share our views a little bit. I'm not gonna talk at you for 45 minutes. That would be very boring and not a great way to enjoy your dessert. And I want to just reiterate, I want to talk about what you want to talk about. I want to answer your questions. So please, we do this because like sometimes people don't want to like stand up and raise their hand in a big crowd, but if you've got something that you want to talk about, please write it down and someone will be around to grab it, and we'll get your questions answered. I'm going to go through, I've got maybe 15, 20 minutes of prepared remarks to talk about how we're thinking about the world at the moment, what we think is going on in markets. One of the reasons I love my job is because there's always something to talk about. The world is always changing. I think we're in a really interesting place today from what's going on with respect to both monetary and fiscal policy with geopolitics, obviously with technology, with everything that's going on with AI. That's obviously a massive story as well. One of the reasons I think that we are really kind of culturally aligned with the Paul Ried Financial Group is Paul talked a lot about education, like financial education. I think we do a pretty woeful job in this country in general in terms of kind of like early financial education and getting people earlier. I know something Paul is very passionate about. It's something that I'm very passionate about as well. I volunteer for an organization, a nationwide organization in Boston called Invest in Girls. Invest in Girls partners with girls in high school who typically kind of get left by the wayside, certainly in financial education. I partner with a good friend of mine who chairs the finance department at Northeastern University, and I sit on an advisory council for her for curriculum planning for the finance department. So that's something that I really believe a lot in, and I think we do a pretty bad job as a country in investing in financial education. The reality is you've got a great team in place in Paul and Tim and Adam and the rest of the team, and they do a really good job. And I think that's like something that we're really well aligned on, something that we think is really important. I think the first thing that I would say is I like the glass half full, glass half empty question. There were definitely not, like the percentages of those answers did not sum to 100. In terms of the hands that I saw up. So I think there were a bunch of people who were kind of on the fence, maybe undecided. And I think, look, I worked in asset allocation for a long time. I managed portfolios for a quarter of a century. Compounding is really important. That's like, there are a lot of engineers in the group here, and obviously like the underlying math of compounding returns is like an extremely powerful phenomenon. And so Tim mentioned obviously time in the market, not timing the market. You do what you do, and you kind of like let these folks take care of the nest egg that you've worked so hard to build over time. Paul and his team rely on us to make some of those tactical decisions and kind of like do some of that kind of tactical rotation over time. And that I think is like a really important part of our message at the moment, which is if you think about what's gone on in the equity markets over the last few years, it's been a pretty good run. so like I think I'm gonna talk you through a handful of these slides. I'm gonna skip around a little bit, but if these will advance, not advancing. There we go. Come on. There we go. I sat in that back table, and these are really hard to see. So I know, I maybe look like I have a little bit of a baby face, but my eyesight is not great either. And when I was sitting back there, it was not hard. So I'm going to tell you what you're looking at. So this is basically just a chart of cumulative trailing 2 and 3 year returns on the S&P 500. So basically, like what's happened in the equity market over the last 2 or 3 years, I would say is not something that we should come to expect always and forever going forward. So in the trailing 2 and 3 year returns that we've had in equities in the US, that's in the 95th and 94th percentile, respectively, of 100 years of history. Right? So like 100 years of equity market returns, we've had an incredible last 2 and 3 years. Like that, I would say like the first thing is like, let's not get too conditioned to have that, to expect that going forward. Like it's not, no one should expect 25% returns on equities every year for the rest of your lives. Like that's just not how the world works. I think over 100 years of history, the equity market has returned something like on average high single digits, call it 7 or 8% a year. So like we've kind of overachieved in terms of where we've come over the last couple of years, and so I think it's important to figure that into your plan and figure that into everyone's plan. So my message is not one of run for the hills. There's nothing super scary going on. In fact, I think the economy is actually in pretty good shape. We're going into next year with the Fed in kind of easing mode. We're going into next year with this one big beautiful bill which continues the tax treatment, the preferential tax treatment of full expensing of capital expenditures and any kind of capital goods investment. So that's I think good for earnings in general. But I think like one of the messages is like let's maybe tap the brakes and let's not get too greedy and think about like more normal times ahead as opposed to expecting the blockbuster kind of incredible return run that we've just had in the last couple of years. And so I will go back. There's a little bit of a tape delay with this mic. And so the result of what that run has meant is it's leaving the equity market pretty expensive, right? So when we think about valuations or the run up in equities that we've had, that has left stocks in general pretty expensive. And so what this chart is showing you, just on a handful of different valuation metrics that we look at, price to free cash flow, price to forward earnings, price to book, a whole bunch of different things. Like almost every metric that you would care to look at from a where is valuation in the equity market would say the U.S. equity market is pretty expensive right now. In fact, the only one that's not like, kind of in that top decile is price to free cash flow. That's actually probably the best one. It's probably the one with the most quantitative efficacy over time. But even that looks pretty expensive. So that's that's a message of Paul mentioned diversification, whether it's chocolate dessert or apple crisp dessert. Diversification is really important. And that's like one of the messages that I think is we should kind of pay attention to now, which is, maybe if you haven't, and I know Paul and Tim and team with Adam do a really good job of rebalancing regularly. That's a really just like, I will tell you as someone who's like studied markets for a long time, studied how you generate wealth, how you maintain wealth, how you grow wealth, is a lot of this is just like basic blocking and tackling stuff. So just like a regular routine of rebalancing is really important. I know they take that very seriously and do that very regularly on a pre-program basis. And so that's like one of my messages to folks who maybe don't have the discipline of your team would be, look, if you've been sitting at the blackjack wheel and 00 has come up like 8 times in a row, maybe take some chips off the table, right? It's like, you shouldn't expect that, like over and over and over again. And so in the same way that you shouldn't expect stocks to keep going up 25% a year every year. So like that, like one of the messages is, again, this is not a run for the hills message. This is not a time to get super defensive message, but it is a message of if you haven't rebalanced, if you haven't taken some chips off the table, we've had a pretty good run. It's probably a good time to do that. And so then the question obviously becomes, well, what do you do with that money? What do you do with that capital? And so I think for us, and from an asset allocation perspective, the thing that we're talking most closely about is this idea of maybe thinking about moving some of that equity into cheaper parts of the equity market that aren't super expensive. And that kind of gets you naturally to fixed income. So fixed income, I think of, Paul and his team use slightly different language. I think of it as like for any sailors that we have in the room, I'm a sailor. And so I think of like when you put your sail up, like that's your go button, right? That's your step on the gas. That's the thing that powers you. That's the kind of growth engine. That your sail would basically be the equity part of your portfolio. And the big lead keel is the ballast under the boat that keeps the boat from kind of tilting over. And so I think of the fixed income market, I think of bonds as that ballast. It's that keel that helps diversify your overall portfolio. It tends to zig when other stuff like risky assets are zagging. And fixed income is actually in a pretty good place to benefit from that right now. The first thing is, oh man, this keeps, there we go, sorry. One of the nice things about fixed income, I'm a former quant. I minored undergrad in econometrics and statistics. I spent the first part of my career as a quantitative analyst. The nice thing about fixed income for the engineers in the room is like it's the most, of all financial markets, it's the most quantitative math-driven one, right? Like when you buy a bond at a yield of X and you hold it to maturity, you're going to end up with the return of X. So that's a very nice, probabilistic outcome that you can kind of rely on. What this chart is showing you, this is basically just a scatter plot of kind of long-term returns based on where you buy a bond at and its starting yield. And so as we look today, we think about like the interest rate environment in the United States. The Fed has now kind of come off of this incredible tightening cycle in 2022 to respond to inflation, and we're now in this place where inflation is a little less scary. It's still maybe slightly higher than the Fed would like it to be, but it's like looks like it's on its way back down to their target. We've got rents rolling over in the United States in aggregate, and so rents over a kind of a slow-moving period start to feed into inflation, and so the fact that rents have come down in the U.S. in general means that inflation will kind of continue to this kind of downward trajectory in the first half of next year. And I think the Fed knows that and is kind of like seeing that. Powell sounded a little bit hawkish in his press conference, sounded like he was a little bit still more worried about inflation. But we've had a couple of speeches in the aftermath of last week's Fed meeting where some of the other Fed speakers, some of the voting members on the FOMC have talked a little bit more about being a little bit more worried about the labor market and a little bit more worried about the fact that the U.S. is not creating as many jobs as it has in the last couple of years. And so the balance of risks have kind of like shifted to growth, and that's the reason why now we're in this environment where the Fed can kind of continue this easing path. And so the futures market, which kind of like prices in the probabilities of future monetary policy, have something like another, call it 100 or 125 basis points, or kind of call it 5 quarter percentage point cuts in the policy rate between now and the end of next year. That feels about right to me. That feels like pretty reasonable and pretty justified based on those balance of risks, which means we've got the 10-year Treasury note yielding somewhere a little over 4%, kind of call it, has been bouncing around between 4 and 4.5%. If you go out and take a little bit credit risk, if you buy like a triple B or single A rated corporate bond, which is also still pretty safe, you can get yields up to 6%, for example. So there are other things that you can own in the fixed income universe where that 6% is, again, if you're thinking about buying a bond and buying it and holding it till maturity, if you can lock in a 6% return, that's pretty good. And that's basically what this is showing you is like the explanatory power of the starting yield at which you buy a bond is extremely high in explaining your longer term forward returns. And so like to me, this is a pretty good trade-off to make right now where yields are in a balanced portfolio, in creating some of that diversity in your portfolio. It's a good way to kind of hedge some of the downside in risky assets to the extent that we get some volatility. Now, the reason that this is important now in a way that it probably wasn't a year ago or 18 months ago or 24 months ago is because, one, as I said, now the Fed has gone from tightening mode to tightening monetary policy because of this inflation spike in 2022 to now an easing mode. But the other thing that inflation risk does is it makes the diversification impact of bonds with stocks a lot less powerful. And so we're in this mode now where stocks and bonds are actually better diversifiers now than they were 18 months ago or 24 months ago, and that's really important. So we've reset yields a little bit higher. We've kind of increased the mathematical impact and the importance of bonds as a diversifier in a diversified portfolio, and that's a really important and powerful concept in finance. It's like people talk about this all the time. Is like diversification is really the only free lunch in finance and asset markets, and that's a really important lesson, and one that we know that because of who's taking care of your money, we know feels really important, feels really strongly about that as well. So I'm going to go back one more if I can get this slide up. Yeah. So this is. So I want to. I would be silly to talk about markets and talk about macro risks without talking about AI. I know that that's probably going to pop up to the extent that people have some questions. I know that that's going to pop up as a question where we are in AI. Look, I started my career at my previous employer in the summer of 1999, so like smack in the middle of the dot-com bubble. And so I came into a team that was relying on valuation tools exclusively to say valuation doesn't make any sense. We want to be underweight equities in our portfolio because valuation, it feels kind of silly right now. And then that left a really important and powerful impact on me as an investor over those next several quarters because the stock market just continued to go up. Like it felt like 1% every day. And so here we are in our multi-asset portfolios being underweight equities and felt like just getting our faces ripped off every day relative to our peers, relative to our competitors. So that, I think, did a couple of things. So one is it reinforced this idea that financial markets can kind of go on these trends and on these momentum runs that last a lot longer than you think they can run. That they can run. And that was a really important lesson. I think the second lesson was there needs to be some balance between just pure valuation considerations and thinking about the other stuff that's going on in the environment, in the markets. What does the policy backdrop look like? What does the macroeconomic backdrop look like? And so I think there are some pretty important differences between now and that dot-com bubble period in late 1999 and into early 2000. The NASDAQ peaked in March of 2000. I don't know a single great investor, super smart, the handful of like super smart investors that have been doing it for a long time that I know and trust and I think are great, that can tell you exactly what it was that like tipped the scales in favor of the markets peaking in March of 2000. No one has a really good explanation for that. There was no one event. There was no thing that kind of like triggered equity markets selling off, and then it obviously lasted quite a while. It was exacerbated, obviously, by the September 11th attacks. Maybe we would have had a recession had the September 11th attacks had happened, but maybe not. We don't really know. So I think, to the extent that I'm one of the rules I kind of think I believe in pretty strongly as an investor is like this idea that it's never different this time, right? But each of these cycles kind of rhymes a little bit, and there's always like something a little bit different, and the characteristics and the nature of them are always a little bit different. And I think that's true this time as well, which is if you think about the makeup of the industries and the companies that were soaring and going up every day in that late 1999 period and making up the drivers of equity returns, these were companies that like didn't really have a great business plan, they were losing money, maybe we're generating some revenue growth, but also maybe weren't, right? So they're like very extremely low quality companies, whereas now you think about the Mag 7, the Magnificent Seven companies, the hyperscalers, the Microsofts, the Googles, the Amazons, NVIDIA, like all of these mega cap tech companies, These are incredibly profitable companies. They've got somewhere on the order of 40 to 50% operating margins, so they're throwing off a ton of free cash flow, growing sales really strongly and aggressively. We've just finished, I would say, kind of like the busiest part of earnings season for the third quarter just within the last week or so, and all these big companies have reported, and they've all reported incredible earnings growth, incredible revenue growth. And so I think, yes, they are expensive, and the equity market in aggregate looks pretty expensive. But I think it's wrong to kind of compare where we are now to the dot-com bubble in 1999, given how incredibly stark those differences are with the makeup of these companies and how profitable they are, right? So that to me is like, I think one of the messages is like, let's not get, again, as a quant, like degrees of freedom are really important, like diversity, like the count of like how many observations we can make before we can infer anything that's important from these events has to be a lot higher than 2, right? Like it was like, we don't have a lot of bubbles to draw upon from kind of like learning things and to be able to kind of like make some summary statistics about what happened and what went on. So I think it's really important to kind of like understand how important the differences are between now and that period of time, because that's like something that I think the people probably who answered the glass half empty question, I think valuation is clearly one of those concerns where, like I even said it, like you shouldn't expect stocks to go up 25% a year. And that's definitely true, and the equity market is definitely expensive, but I think there's a reason that some of these companies are expensive. And there are plenty of other places in the equity market where you can find good growth and you can find high quality companies that aren't as expensive as the overall market itself, aren't as expensive as the Magnificent Seven. So that would be, that could be like, as I kind of go back to think about that advice of like, we're starting to take a little bit of risk off the table. We're using the proceeds from that, kind of taking some of that risk off the table to add to fixed income and to add to cheaper parts of the equity market where there's still good growth and there's still reasonable prospects, good high quality companies to own. We'd just rather own the cheaper ones right now. I would say, I think AI is real. I think we're using it in our business, and I think that's one of the big things that, if you think of it, as I've listened to a lot of the earnings calls and read a lot of the earnings transcripts from third quarter reporting season, one of the main questions that analysts are asking CEOs and CFOs of public companies is, what are your plans for AI? What are you doing with AI in your own business? And so obviously it started with the tech companies. They're the ones that are in the best place to know how to use this stuff and to kind of like understand where to gain efficiencies from this stuff. It started mostly with coding assistants, right? Like, tech companies write a lot of code. Google employs something like, thousands and thousands of software engineers whose job it is to just write code all day, right? To like create new software, write code. If you've got some of these coding assistants that can do half of the work for you, then you can spend your time on smarter stuff. You can spend your time on debugging the code. You can spend your time on thinking about strategy or where we want this to go, and not the kind of mundane, boring part of just like sitting and writing. So that was an obvious like first good use case for some of these AI tools. We're using it in financial services in a big way, so our portfolio managers and analysts will use even something like Microsoft Copilot, right? So you could take a earnings transcript. You had 2 companies report at the same time last week. You could listen in on one of the calls, but you didn't get to have time to listen in on the second call. I can take the transcript from that second call that I didn't get to hear, dump it into Microsoft Copilot and say, give me a bullet point summary of everything that happened in this call, right? And so that saved you literally an hour and a half of your time and getting just a bullet point summary. So like those kind of productivity gains, I think are really powerful, really important, and all of that stuff is coming and it's on the way, and people will start to figure out how to use this stuff. Now, look, I will say, so this last chart that I will point out is, for me, I think in terms of like the crystal ball, when I think forward looking, one of the things that I always ask myself, I tell all of the portfolio managers, all of the analysts to ask themselves in their work, which is, what is priced in? What do you think you know that the market doesn't know, or that everybody else that's doing this job doesn't know and doesn't appreciate? So this is essentially a bar chart through time of NVIDIA's earnings surprise relative to consensus estimates, right? So like every quarter when NVIDIA reports earnings, There's a median number of all the analysts that cover NVIDIA and what they're expecting for NVIDIA to report earnings. And so, for the last couple of years, like that earnings surprise has kind of come down a little bit every quarter. So NVIDIA now, we won't get that number for another couple of weeks. NVIDIA reports their next earnings report in about 2 weeks. And so we'll see where this is in the next earnings report. But like, again, this idea that they have to keep surprising to the upside to get this stock to kind of keep going on this like incredible run for a company that's now worth $5 trillion, right? More than the market cap of a lot of countries in the developed markets, let alone emerging markets. So it's really important. It's because it's such a big driver of returns. The S&P had a pretty good October. 80% of the return on the S&P in October was driven by the Magnificent Seven, right? Just these 7 stocks out of 500. For the S&P 493, it wasn't that great. So again, this idea that like these big giant companies have to keep surprising on the upside, kind of fighting against the law of large numbers, that is going to be, I think, a pretty big challenge going forward, and we'll see. But I do think AI is real. I do think we're going to keep finding use cases for the tools. And again, like one of the other rules I live by is like, if you tell me how someone gets paid, I'll tell you how they behave. Jensen Huang owns a lot of NVIDIA stock. So like, of course he's going to say everything's great and we're going to keep growing to the moon. And that's true for Sam Altman as well. So Sam Altman has said for OpenAI, right, like just the maker of ChatGPT, if you ask them what they think their power needs are going to be, in terms of growth from now to 2030, so just for the next, we're coming up on 2026 pretty soon, so that's not that far. 2030 is not that far away. This is like a scope of reference. Seattle Metro uses about 9 gigawatts of power. The electricity and power consumption that NVIDIA has baked in by 2030 is basically 15 Seattles, 15 Metro Seattles, right? So to me, it's not a question of like whether these tools are going to be useful or not. It's the power access to power is the real bottleneck for a lot of this stuff. For the building of the data centers, where you co-locate the data centers, who has spare capacity. That's to say nothing of the fact that from a political standpoint, when constituents of both parties start to see their electricity bills going up 15, 20%, 25% year over year, this is going to also create some political problems, right? So if governments that have been in place at the state and local level have kind of given preferential treatment and tax deals to some of these data centers, and then now your constituents who live next door to a data center, their electricity bills start going up, that's going to be a problem, right? That's going to be a political problem. So I would say, I'm going to, where are we? We're about half an hour in. I'm gonna just like close and wrap up, and we'll hopefully start to ask a few questions, and hopefully we've got a few people that have written down some questions. But I would say my main message is, like, as I said, like going into next year, like things look okay. Like the economy is in pretty decent shape. Certainly the labor market is slowing and hiring is slowing, but nothing is falling off a cliff. We've got, obviously with this Trump-Xi meeting, we've got some de-escalation in the trade war rhetoric. So things have kind of like settled down from that perspective. I think, we've resolved, or it looks like we're like on the way to resolving some of these kinetic hot wars in other parts of the world. So the geopolitical landscape seems like it's at least, on a low simmer. It's not on a rolling boil. So that is good. Fed's in an easing cycle. We've got a little bit of fiscal stimulus in the first half of next year as well. And these companies are still growing. So like that, to me sets up a pretty reasonable, like a pretty reasonable backdrop for risky assets, a pretty reasonable backdrop for financial market returns in general. I would say again, like maybe don't expect, like I said, like the biggest part of my message is like maybe don't expect the return on the equity market that we've gotten in the last 2 or 3 years, but I don't see anything like falling off of a cliff either. So, your team, as I said, Paul, Tim, Adam, like this idea of like blocking and tackling, just basics, right? Like just programmatic strategic asset allocation based on your circumstances, rebalancing back to those strategic asset allocation targets over and over and over again, being disciplined about it. The blocking and tackling stuff is really important. And I know they do that really, really well. And so that's that's my main message is like things are in a pretty good place. Like, I'm not in my third yet. I'm not in my last 11,000. But for those of you who are, they're like, you can rest assured, like at least like there's not that much that should keep you awake at night. Like let me stay awake at night with the worry stuff. For you in that last 11,000, either like at least for the foreseeable, certainly for the next 6 to 12 months, I think things are in pretty reasonable shape. And if I come back a year from now and that's still the same message, then we'll have all done a good job, and everyone will continue enjoying 11,000 minus 365. So Paul had a Alice in Wonderland reference. I know there's like a handful of questions, so like let's go down the rabbit hole. Let's see what we got for questions out there.
All right, I'll start this one. This is in regards to tariffs and the market. It says, are tariffs the end game, or is the current administration using them for leverage? Where does it go from here?
Yeah, so big day today. So the Supreme Court is actually hearing oral arguments in this case of the use of the IEPA, the International Emergency Economic Powers Act. That's a mouthful, but it's basically the justification that Trump has used, that there's this kind of economic national emergency to impose the tariffs. And so the Supreme Court is actually hearing those arguments, maybe as we speak. The early indications that I saw a little bit before lunch was served was that a lot of the questioning on both sides, but from like the conservative justices and the more liberal justices, were both sounded kind of skeptical. So like I think the betting odds and the prediction markets are that they will actually like strike down the ability to use IEPA to impose these tariffs. And so then there's this question of like, that opens up the potential for this kind of like another gaping hole in the budget deficit if we've got to cut a check for $100 billion to refund all of the tariffs that have been brought in so far. So that's, I think the base case, I think, is probably that Supreme Court will strike down the use of IEPA for these tariffs, and there will have to be a rebate given back. I think that's a little bit of a fiscal stimulus, like that, like that's a incremental additive to the corporate sector, kind of a windfall of like you do laundry and then, a week later you find $20 in your pocket. Like that's money that these companies didn't have before, and so there's been this debate about like who is paying the tariffs, right? Are the importers paying the tariffs? Are the retailers like passing those costs on to the end consumer? And so like I don't think we have a great answer to that, and it actually it depends a lot sector by sector on kind of like what specifically we're talking about, what tariff, what product, in terms of the balance of who's paying the tariff. So it's hard to kind of come up with an aggregate attribution and balance on that. But my personal view is, I think this has been negotiating ploy all along. I think this de-escalation with China over the last couple of weeks, I think to me signals that that's been the case. And so like getting the rhetoric to dial back a little bit. Like I think, look, China has kind of come into this with some leverage on their own in terms of rare earth metals and materials. Some of the stuff is the ability to process it almost entirely resides in China. That's why the U.S. has been kind of trying to strike deals with places like Australia to try to do some of these things. And like I think it was like some of the, it's certainly some of the reason why we've been, I think, reluctant to cut Ukraine loose and let them fend for themselves, is because I think the Trump administration would very much like to have a deal to get access to some of those mineral deposits in Ukraine as well. So I think a lot of this has been bargaining power and leverage. It seems to me a little bit kind of like self-defeating to wage trade war just for fun. And I think like now that we've got in this kind of like de-escalation period, I think that is kind of like showing itself to be what's actually happened.
Jason, another question. I don't have a mic.
Yeah. So the question is basically, what about crypto? Like what's going on with crypto? How important is it? Is this real? Is this going to be around forever? Or we need to think about like kind of like our financial architecture and plumbing. All really, really good questions. I bought one Bitcoin for fun at like $8,000, and I've kind of thought of Bitcoin in particular, not necessarily some of the other more fringy coins, but Bitcoin in particular because it's the kind of the marquee one, and the supply of it is kind of grows at this kind of controlled rate as digital gold, like a lot of people. I'm sure you've heard that phrase before. I also own a little bit of physical gold, right? Again, this is like a very small percentage of my overall portfolio in physical gold and Bitcoin, essentially just as a hedge and just as a diversifier. It's not big, but I think it makes some sense to have a little bit of it. And the Bitcoin thing is like, it's been mostly for fun to just like see what happens with it. We've got a really good tech investor on the West Coast, runs a shop called Seligman Information and Technology. He runs a hedge fund. He's been doing it for almost 40 years. He will refer to like some of these more fringy coins as shit coins, pardon the language. So like some of the stuff is clearly fraud. Like some of the stuff is like gonna go away, will be worth zero for sure. Like I think Ethereum and Bitcoin are like real and will be around for a while because the supply is fixed. But some of this stuff is clearly gonna have to turn out to be fraud and games and like Beanie Babies, right? Equivalent of a Beanie Baby. And I think that's all fair. I think what is real, like as kind of like linked to crypto, is this idea of tokenization and blockchain technology, right? So like the idea, like when you think about the evolution of our banking system over time, I'm come from Boston and was like born and raised in the Boston area. Like Boston forever has been basically like was the place where trust banks essentially started in the country. And so trust banks then kind of like morphed into custodian banks. And so when you think about something like State Street is one of the biggest custodian banks on the planet. State Street is headquartered in Boston. That all started from the beginnings of trust banks in the Northeast, in the early part of the country, and its financial history as a place to just kind of park assets and store assets. And so when I think about something like stable coins, right? So like the bank, all the major banks are kind of talking about stable coins. Is this idea of like when you kind of deposit cash in a savings account or a checking account at a bank, it's a store of wealth. My grandmother was essentially a product of the Depression and literally had a Ziploc bag of cash in the freezer when I was a kid. These are, like for people who basically got burned by the banking system. And there are places all over the world where you can very easily get burned by the banking system. I suspect, I was in Argentina 18 months ago. I suspect if you're Argentinian, you're probably pretty worried about getting burned by the bank system, right? Like the currency went from like 300 to the dollar to 800 to the dollar in the span of essentially 6 months. So this idea of a stable coin it's kind of tied to cash. It's tied to a physical store of dollars somewhere that sits with a custodian or sits with a trust bank, and you can have it to do with what you want. Like you can basically pay for stuff with it, right? It's like as good of a dollar, but it doesn't have the problem of like having carry a bunch of cash around with you. Now we've got obviously we've morphed a lot in the financial system around that, right? You can pay for stuff with Apple Pay. But that's linked to a credit card, so it's not quite the same as cash. There's a credit component to that, like debit card, right? That's kind of like cash, but there's still kind of like this link back to the banking system. And this idea of stablecoin is like you carry around your cash, but it's like tied to physical currency, and physical U.S. dollar is like held somewhere for you, so it's not expected to grow in value. It's just like the same as cash. So it's really about the medium of exchange, right? Like how do you pay for stuff and how do you use it to exchange for, like I've got this thing and I want to trade it to you for like a latte. Like that's kind of not a crazy idea. I actually do think this idea of tokenization and basically like owning a share of something, but like having that, basically how do you keep the record of that? So this idea of tokenizing art, or tokenizing a wine collection, or tokenizing a holding in a private company, shares of a private company, like we need a way to kind of like keep track of all that stuff, and our financial architecture isn't great at that right now. So blockchain is a good way to do that, right? There's this distributed ledger. Everyone kind of can see the ownership and the origin of ownership of this thing and when it changes hands. And it's hard to hack because there are copies of it everywhere. You can't go back and like change the kind of like previous version of it without kind of a pass key, and like there's only kind of like you only have the pass key for your stuff. So I do think tokenization is going to, I think our financial architecture, our financial plumbing is going to continue to morph in a pretty meaningful way over the next few years. There are several mutual fund companies now and investment companies now that actually have tokenized money market funds, for example, right? So you get instead of owning a share of a money market fund that gets held at a custody bank, you've got this kind of tokenized version of a money market mutual fund that you know about, and it sits on your record of that ownership sits on the blockchain. So I do think that's all changing pretty rapidly, and I think is going to evolve how we think about owning stuff over time, which is I think cool and is powered by technology, and is one of the reasons why I think we get caught up in the data center build out, tying that to AI and large language models and inference, but the need for compute. When you build a data center, you're basically building out compute capacity. Microsoft here is a really good example of that. Microsoft's Azure cloud platform is maxed out, or they're literally we're out of compute. We're building data centers because we're out of compute. And compute gets used for a lot of reasons. It gets used for cloud computing, right? If you've got a laptop or an iPad at home, none of the software sits on the physical laptop anymore, right? It's software that's in the cloud. Your files are stored in the cloud. The ability to kind of process that and do that in real time with kind of no latency requires new cloud computing technology and new kind of compute capacity. And we're going to need a lot of that stuff for changing a lot of this financial architecture as well.
The next one, this is in regards to high valuations. It says, we heard this message last year too. What might bring on a correction?
So again, I will go back to one of my earlier comments, which is I don't know a single smart person who can tell you why the equity market broke in March of 2000 in the dot-com bubble. So I don't know, and the answer might be nothing. It might just crack on its own. It might get to the point where collectively the market just says it's too much. So I talked about going down the rabbit hole. I don't want to bore you with too much rabbit hole jargony stuff, but one good way that we have of measuring valuation, I think it might have been on that earlier slide, is something that we call CAPE, or the cyclically adjusted PE. And so what that does is it smooths earnings through time and takes an average of the earnings over some kind of longer period of time. So you're not looking at earnings, you're not looking at prices to a local high or a local low in earnings, right? You're kind of smoothing what companies have done in earnings growth over the last several years. That cyclical PE, what people call it the Shiller CAPE, Professor Shiller at Wharton kind of developed this metric. There's nothing magical about smoothing earnings over 10 years. You could smooth earnings over 7 years. You could smooth earnings over a longer period of time. It doesn't really matter that much. But when you think about price, what you're paying relative to kind of $1 of smoothed earnings, of that cyclically adjusted earnings, this concept was created by Robert Shiller at Wharton. That number right now is at about 40 times. So at the market level, we're paying about $40 per $1 of kind of smoothed earnings. The last time that number was at 40 was in the end of 1999. So that's not great, obviously, but again, this idea that margins are higher, right? Like these companies are actually generating more bottom line earnings based on $1 of revenue because margins are higher. That's important. Balance sheets are a little stronger, a little bit more high quality, so companies tend to have less debt on their balance sheets now than they did in 1999. I think that's important. So it's really hard to compare apples to apples across time because the composition of the equity market looks different, right? Like the industry and sector composition looks different, the quality of the companies looks different, all of those things. So I don't know what it is that will ultimately break valuations or get valuations to roll over and come down and put pressure on some of these valuations. It's also true that the dispersion amongst valuations, like if you look at all 500 stocks within the S&P 500, the dispersion from the cheapest to the most expensive is also really high. So there's a lot of stuff, the equity market indices that we talk about a lot, except for the Dow. The Dow is price weighted. I hate talking about the Dow because I think that's a stupid way to create an index by weighting companies by price that their stock price trades at. That just makes no sense to me. We do cap weighted, market cap weighted, right? So basically the size of the value of the overall company determines its weight in the index. We also like to look at an equal weighted index of the S&P 500. That's a thing that's out there that anyone can look at. So it kind of basically skews towards the smaller companies that aren't as big, their market caps are lower. The equal-weighted S&P 500 is actually at a pretty reasonable PE at the moment. And so there's, again, a lot of stuff if you kind of look down in size, if you look at other sectors that aren't kind of like tied to technology now, that actually look pretty reasonably priced. And so like that gap between the valuation in the market cap weighted indices and the equal weighted indices is actually extremely wide right now, which suggests to me that there's some opportunity in cheaper stuff, and that's maybe not something that we have to worry about as much, because the biggest companies are the ones that are the most expensive.
Yeah, great. Jason, another question came in through regarding, you mentioned in your presentation the Mag 7 stocks, obviously the great performance there, and then you mentioned that there are other opportunities. Where are you seeing other opportunities, and where does international come into that?
Yeah, great question. So for sure, I think there are parts of international that are as interesting as they've been for a long time. I think Japan's equity market is cheap. It's kind of always been cheap relative to the U.S., but it looks like pretty historically cheap, or certainly it did a couple of quarters ago. So again, the Nasdaq is up, call it 22 or 23% year to date. The Japanese equity market, the Nikkei 225, is up 35% year to date. That's incredible, and I think part of that is due to the fact that now Japanese companies are paying more attention to shareholder value, doing things like paying dividends, returning capital to shareholders, buying back stock, all the things that you do to kind of reward shareholders and kind of give capital back to shareholders. The Japanese stock exchange has just recently incorporated this rule where if your stock is trading at less than book value for a prolonged period of time, they can delist you. Like you can actually, your company can be delisted from the Japanese stock exchange. So that's enforced some discipline on Japanese companies to get their stock to trade above book value, and doing things like paying dividends and buying back stock is one of the ways to do that. Japan has been a little bit more open-minded to, for example, activist investors and private equity investors coming in to restructure companies, to buy companies that are underperforming or kind of performing at a kind of a suboptimal level, and kind of restructure those companies to generate higher margins. Maybe if they're under levered, to put a little bit more leverage on their balance sheet and grow faster. So there's I think a lot of really cool things going on in Japan at the moment. We've been bullish on Japan for a while. I think we'll continue to be bullish on Japan. There's some parts of Europe I think that are kind of interesting as well, where growth is okay. Like Europe is kind of has worse demographics than the U.S. It has like almost as bad demographics as Japan. Europe, in the best of times, maybe grows GDP in real terms 1% a year, but you can still generate reasonably good growth as a public company in that environment. And if you look in some place like Spain, where there's been some structural reform, Portugal is growing very rapidly. There's some pockets of places in Europe, in developed markets, that are also growing pretty rapidly and are also pretty cheap as well. And that's a good way to kind of diversify your U.S. equity exposure, and kind of like get the, smooth the ride, which is really what we're talking about when we talk about diversifying your equity exposure.
Perfect. And this one is the solar industry impacted by the lack of electric supply? What is the outlook for energy supply versus demand?
Yeah. Look, this is a really tough question because, as I said, I talked about OpenAI's plans for data center requirements needing something like 15 Seattle Metro's equivalent of energy supply. I just think that's the real bottleneck. I don't really think there's a feasible way to get there between now and 2030. You can't, we're in the process of kind of restarting 2 nuclear power plants at the moment. That takes years, not months, not quarters, years. And that's to say nothing about building new, nuclear generation capabilities. There are a lot of smaller firms now backed by a lot of VC money. Bill Gates is backing one that are looking at nuclear, either small modular reactors, so like a nuclear reactor basically the size of like a 18-wheeler semi-tractor trailer truck. That's a possibility, but we haven't started building any of them yet because none of them have been approved yet. Obviously, people are talking a lot about I don't mean to dismiss the idea, but I think with a lot of wistfulness and wishful thinking about nuclear fusion technology, Maybe with the advent of quantum computing, we can get there. But again, that's, I think, many, many years off at this point as well because of the feasibility of quantum computing. So I think this is the real bottleneck, and this is going to start to bite. Like the ability to get spare capacity in power generation in the U.S. Is going to be the thing that bites from a bottleneck perspective over the next couple of years. We've got no new nuclear reactor construction happening at the moment. I think China has something like 15 nuclear reactors under construction at the moment. So China has access to power. That's going to be an advantage. I think it's like there's just no way to get between here and there on any feasible time frame that's like less than 3 years. So.
Yeah, one last question here. So your opinion on the potential demise of the dollar, right? The weakening of the dollar, and kind of what does Columbia Threadneedle think about that and kind of the future of the dollar?
For sure, absolutely, yeah. So I think, again, this is a weaker dollar or a dollar under pressure is actually a tailwind for international assets. So you get the currency impact of stronger foreign currencies when you own international equities. So for example, if you own Japanese equities and the yen is strengthening relative to the dollar, that's a kind of an incremental boost that you're getting in your returns in those markets. Same thing with euro, to the extent that you own European equities and the euro is stronger relative to the dollar, that's going to be a tailwind for you in return space. I think this kind of hawkish Powell press conference last week has given a little bit of a bid to the dollar in the short term, but I would say my view is we are kind of still structurally bearish on the dollar over the next couple of years, over the next 1 to 2 years. I think the dollar is kind of biased to weaken, maybe not against any one individual currency so much as in general across, for example, a basket of the G9, so G10 ex US, against emerging market currencies in general. The reason I think that is, one, the dollar is still on a lot of metrics overvalued relative to a lot of foreign currencies. So if you look at real effective exchange rates, for example, the dollar still looks overvalued. I think it's a Trump administration policy to want a weaker dollar, right? If you look at, Scott, what some of the things that Bessent or Mirren or Trump has said, they clearly want a weaker dollar slowly over time because it alleviates some of these pressures that they've talked about with respect to trade, with respect to balance of payments, imbalances around the world. So I think it's a way to release some of that pressure without really kind of like rocking the boat too much, right? It's kind of like a low risk pressure release valve in some of these imbalances that Trump has talked a lot about. So I think they want a weaker dollar. A U.S. Treasury Secretary is never going to come out and say that out loud, but to the extent that you heard this idea of like a Mar-a-Lago Accord several months ago, that was all stuff that Stephen Mirren had been talking about. And so I think there's this idea now that they're happy to let the dollar kind of slowly weaken over time because it does alleviate some of these imbalances, and I think it provides a tailwind for some of these other parts of the equity market to work a little bit better and benefit from that. With that, I want to thank everybody for your time, and I didn't see a single person doze off, so that's after dessert. That is very impressive, and maybe it was coffee, maybe it was chocolate, but I appreciate your time and thanks for coming. Thanks, Paul.
Thank you, Jason. Great job. Well, thank you, Jason. We appreciate your insights. Wasn't that good? Yeah. Good. Well, as we wrap up, I have 4 takeaways, the drawing, and then a quick story. So you ready? Okay. The 4 takeaways. I always think about when I prepare remarks or hear something, I always think I want to leave with something in my mind. I want to leave thinking about what are the points that were made, what are some of the things I thought about. Now, Jason made some wonderful points. Let me give you some thoughts combining what Jason said and kind of about your portfolio, your financial team. Takeaway number 1, markets always go in cycles. It's really important. Historically, markets decline. This is the S&P 500, 15% or more every 3 to 3.5 years. The last time the market declined by that amount in an annual basis was 2022. Guess what year it is now? 2025. Don't be surprised if this might be happening. But remember, you're diversified. You're not just in the S&P. That's why if I was in an S&P index fund, I'd be very concerned. Second, area is you think about is a couple of quotes. They give it the same thing. Markets go in cycles. This is a quote that I think, Jason, you said. Mark Twain said this: "History doesn't repeat itself, but it oftentimes rhymes." We've heard that before. So markets go in cycles. We can't predict, but we know that there is a cyclical nature of any market. The whole idea of a diversified portfolio, folks, is that when one market goes up, the other goes down. Now, doesn't that work all the time? Of course it doesn't work all the time, but it smooths out those returns. And I love the attention paid for, we call it foundation, bonds. If you're able to get, we've had meetings with Tim, with Kelly, with Georgianne, with me. You met with all of us at one point or another, and we talked about how good that foundation part of your portfolio is doing. It's doing pretty well. And if you think about it, it's probably 1% to 2% above inflation. And guess what happens? Because you're able to take advantage of the higher Fed rates, whereas someone that borrows money isn't. And as rates go down, generally what happens to bonds? They tend to appreciate, don't they? So just remember, it's diversification with a lot of thought, forethought, and a lot of reason behind it. So history doesn't repeat itself, it oftentimes rhymes. Guess what? Sir John Templeton said this: the four most damaging words in investment planning are, "This time is different." Don't ever think that. Now, AI is a big driver of the markets. We've heard that from our speaker. But remember, this time is not different. There might be different nuances to it. So that was takeaway number one, markets go in cycles. Takeaway number two, don't let politics or emotions drive your investment portfolio decisions. You know, I say this almost every time because we can be inundated with news slant one way or the other, and if we're not careful, you can then say, I've got to do something, and what that do something might be. Remember, fear of loss or fear of missing out? So what do? When things go up too high, you think, I got to buy more of it. When things go down, you think, I got to sell. Completely wrong, isn't it? So, and that's one of the hallmarks of what we do. That's why we rebalance. That's why we diversify. Third takeaway, a well-disciplined plan is your best chance for financial success. Now, that goes without saying, but let me give you a couple of quotes that I think will reinforce that. We know Warren Buffett, fabulous investor. What he says is markets reward the patient at the expense of the impatient. Think about that. And by the way, for you that aren't drawing income out in certain areas, because all of you aren't drawing income from everything out, we're reinvesting dividends, and guess what? When the markets go down, we buy more shares at lower prices. So when they go up, there's greater compounding. Think about the compounding discussion we had. And this was brought up as well. By the way, a British economist, British investor named Terry Smith said this: it's time in the market that works, not timing of the market. We've heard that several times today. You've heard it from before. The original person, I did a little search on it, Terry Smith. I haven't heard of him, but that's who said it. John Kenneth Galbraith. Oh, you that studied economics, how many have heard of John Kenneth Galbraith? Okay, a few of you have gone through college. So let me tell you what in economics, what he said was this. This is great. The only function of economic forecasting is to make astrology look respectable. Now, how much time, effort, and energy is placed on economic forecasting? You know, Jason didn't forecast. He said, this is what's going on. This is why we're invested the way we are. So I thought that was interesting. And then finally, the fourth one. So markets always go in cycles. Don't let emotions drive your investment decisions. The well-designed portfolio, the disciplined approach. This is what I would say. Fourth one. We are cautious. This is your team now. We're cautious, but we're confident. And let me explain the difference. And let me explain why. Cautious about the next 6 to 12 to 18 months for a whole bunch of reasons. And you've heard some of them. You know some of them. But we're confident in two major areas that are most important. First of all, we're confident in the long-term direction of the global economy, that we're invested well. And the second thing we're confident about, which is what we have control over, is the composition, the management, and the structure of your portfolios. Because that's what we spend our time doing. We meet with a money manager, my goodness, almost once a week. These are money management companies in our offices. They come from Boston. They come from their local regional representatives, from a number of firms. So it's not just third-party research. And Adam, as you know, our Director of Investment Research, he's structures a portfolio. He's a national, international speaker. He's been Monaco to speak to other financial advisory firms about portfolio construction. So you've got world-class folks on your team, and I'm proud to serve. And Adam, as you may know, is my son as well. Hey, well, thank you all. One quick story, and then we'll dismiss you. It's been a real joy to host this. The story goes like this. There were 3 traveling horsemen. They were riding along a desolate plain. As they were riding along, a heavenly voice spoke out and said, "Stop, pick up pebbles." Well, they'd never heard a voice like that before, but nonetheless, they got off their horses, they stopped, they reached down, picked up pebbles, and put them in their pockets. They completely mystified. And then they went on to their campsite. And then they remembered what that heavenly voice had said, because they said, "Stop, pick up pebbles," but it also said, "You will be happy and sad." So that was really confusing to them. But nonetheless, they reached into their pockets, they remembered what happened when they got to their campsite, and in direct proportion to the number of pebbles they picked up, they found diamonds, rubies, and emeralds. And then they remembered what that heavenly voice had said. You see, they were happy they picked up as many pebbles as they did, but sad they didn't pick up a few more. Now, our hope, our goal, our prayer for all of you is that we've given you some pebbles that you can truly turn to precious gems in your retirement life. So it is truly our pleasure with a deep sense of gratitude from your entire team. Thank you, God bless, and have a safe drive home.